Today's market moves weren't just about a quiet rally. They reflected a subtle shift in how investors are balancing geopolitical relief against persistent inflation pressure. U.S. equities closed modestly higher, but the tone was cautious rather than confident. The Nasdaq led with a gain of just under 0.5%, while the S&P 500 and Dow posted smaller advances. On the surface, it looked stable. But beneath that stability, something more important happened. Bond yields moved sharply higher, with the 10-year Treasury pushing back toward the mid-4% range. At the same time, oil prices declined as geopolitical tensions in the Middle East showed signs of easing, and volatility continued to compress with the VIX slipping below 18. So markets weren't reacting to a single story. They were reconciling two competing narratives. On one side, geopolitical risk is fading, at least in the near term. Signals of de-escalation and continued ceasefire discussions reduced the immediate threat of supply disruption. That allowed investors to unwind some of the defensive positioning that had built up over the past week, particularly in commodities like oil and gold. But at the same time, the policy backdrop became more restrictive. Federal Reserve officials reinforced a familiar message. Inflation, especially in services, remains persistent, and it's still too early to talk about rate cuts. That directly challenged the more optimistic expectations that had started to build after weaker global growth signals earlier this week. So expectations shifted. Investors moved from anticipating earlier policy easing back toward a higher-for-longer rate environment. And that's where the tension in today's market comes from. You saw it clearly in how capital repositioned. Technology and communication services attracted flows, supported by strong signals from the AI supply chain, particularly continued capital spending and demand visibility. These areas are increasingly viewed as structurally resilient, less dependent on near-term economic cycles. At the same time, energy and materials found support from the easing geopolitical backdrop, while real estate saw selective inflows as investors searched for yield. But other parts of the market told a different story. Financials wagged, reflecting sensitivity to higher yields and ongoing concerns around credit conditions. Healthcare and industrials also underperformed, suggesting investors are becoming more selective about cyclical exposure. So this wasn't a broad risk-on move, it was targeted positioning. Capital is flowing toward areas with either structural growth visibility, like AI, or more immediate earnings support, while avoiding segments exposed to rate pressure or uncertain demand. And that raises an important question. Are markets underestimating how long inflation could remain sticky, especially if supply-side pressures from geopolitical events continue to feed through? I'd be curious how you see this. Is the market correctly pricing a temporary inflation bump, or could this turn into a more persistent constraint? Feel free to share your perspective in the comments. Because beneath today's relatively calm price action, there are still clear signs of fragility. One of the key risks is that even with de-escalation, the inflation impact from recent geopolitical tensions doesn't fully disappear. Energy markets may stabilize, but the secondary effects on transportation, production costs, and global supply chains can linger. At the same time, positioning in AI and large-cap technology is becoming increasingly crowded. If yields continue to rise, even high-quality growth assets could face valuation pressure. And in the background, rate-sensitive areas of the economy, particularly financials and real estate, remain exposed if funding conditions tighten further. So while markets appear stable, that stability depends on a delicate balance. The broader macro signal from today's market is not a clean shift toward optimism. It's more nuanced. Investors are becoming more comfortable with reduced geopolitical risk, but they're also acknowledging that inflation may remain a limiting factor for policy, and by extension, for valuations. In other words, the market is moving away from a simple risk-on versus risk-off framework toward a more selective, conditional environment. Looking ahead, several catalysts will test this balance. Further developments around ceasefire agreements will determine whether the geopolitical relief is durable. Upcoming Federal Reserve communication will shape expectations around inflation and policy timing. And critically, the next wave of major technology earnings will test whether AI-driven growth can continue to justify current positioning. Each of these has the potential to either reinforce the current narrative or disrupt it. The broader takeaway from today's market reaction is that investors may be reassessing how resilient growth really is in a world where inflation remains sticky and policy flexibility is limited. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this kind of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And thank you for spending a few minutes here today. I appreciate you being part of the channel.